And this is why I calculate now with the current level of debt that a rise in interest rates at the Fed funds level to around about 2.5 to possibly 2.75% should be enough to trigger the next credit crisis.
Start investing in gold and silver at sdbullion.com today and join over 35,000 precious metals investors who have made the switch to the lowest gold and silver prices in the industry. SD Bullion recently claimed a spot on the prestigious Inc. 500, making them one of the fastest growing bullion companies in the United States. With low bullion prices and over-the-top customer service, SD Bullion is setting the standard for precious metals transactions. Visit www.sdbullion.com today. Start saving on every precious metals purchase you make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com.
And with us today is Alasdair MacLeod from GoldMoney.com. Alasdair, thank you so much for joining us today.
It's lovely. My pleasure. Thank you, Elijah.
All right. Well, you recently wrote an article where you talk about the importance of randomness. And one of the things you talked about in the article is that central banks right now are kind of not enabling the randomness that we should be seeing in a free market. You say that central banks are manipulating money, and this is intended to force everyone to act in the same way at the same time. So can you expand on this, and how does this end up being negative for the overall economy?
Yes, certainly. The great strength of a free market is that people go and do their own things. You go and make things to sell to people, and if you succeed, you make a profit and you're happy. If you don't succeed, then you close the business and you go and do something else. And these actions across the whole economy in a free market with sound money are essentially random. You've got a continual process of people succeeding and failing, succeeding and failing, succeeding and failing. So the reallocation of capital from businesses that fail into businesses that hopefully will succeed is a continual process. It's going on all the time. But when you get a central bank manipulating the purchasing power of money, then the express purpose of that is to get people to move in the same direction at the same time, so that typically you will find that people expand their production at the same time. And then when the credit is withdrawn, they contract their activities at the same time. And this is why business cycles aren't business cycles per se. They're actually credit cycles. They're the result of credit cycles. And if we had an economy which was sound money, free from central bank interference, we would have an economy which doesn't have these cycles. And the cycles, obviously, are reflected in markets as a whole. So a sound money economy is very, very different from what financial markets are used to today.
Now, you talk about in your article that basically ETFs have made the markets appear almost risk-free. How does that work?
Well, there's been a sort of, I mentioned a business cycle which is driven by a credit cycle of credit. But on top of that, there are other investment cycles which basically exist as a result of unsound money. And these tend to be longer cycles. The first cycle, which I mentioned in that article, was from the post-war recession, which was 1921. You had a gathering economy, both in America and elsewhere. You had the Roaring Twenties. And then after that, we had the collapse into the 30s, the Wall Street crash, and then the 30s depression. After the Second World War, we had really an investment cycle because in the 1950s, people began gradually to think, well, wait a minute, the better returns in the long term, even though there is greater risk, could well be in equities. So you had the cult of the equity beginning. And the cult of the equities survived various disruptions. We had the late 60s, there was a bear market. Then back in the mid 1970s, there was a bear market. And in the case of London, I mean, we had so many things going wrong at the same time. We lost 70% of the stock market's value between 1972 and the beginning of 1975. I mean, that was a massive collapse. It wasn't quite as bad as the Wall Street collapse between 1929 and 1932, but it was getting on to that sort of magnitude. I think from memory, Wall Street fell about 50%, something like that. Then you had a recovery after that, which took us through to the 1987 crash, as it were, that very, very sharp and sudden sell-off. And since then, we've had one or two real crises. But the point is that the cult of the equity has survived and gained momentum throughout it all. The point I was making about ETFs is we've finally got to the point where investment managers, having tried to beat the indices, have failed to do that. So what do? They started index tracking. And then the next logical step from that was ETFs, particularly because you can use derivatives to create synthetic performance. And essentially what we have from the point of view of the investor is now an investment mechanism which, from the inexpert investor's point of view, completely de-risks the market. When you buy into an ETF, you don't actually think about risk because your thoughts about risk are really confined to, well, I don't want to buy this company because it might look good on the charts or whatever, but there is a risk that I'm getting it wrong or there might be a surprise. I want to spread my investment. I want to capture the whole market. And in the long term, statistics tell me that I will make money by holding a market-related ETF. And of course, ETFs aren't just tracking the markets, they're tracking all sorts of other things, and they can be geared as well. So you've got something which has ended up at the end of this long development, if you like, of investment into equities, which has consistently, over the period of time, ignored risk. It started with the cult of the equities, and it's now into the ETFs. The ETFs, I think, are probably the end of that long process. Now, it doesn't mean to say necessarily that we have a complete collapse, but what we have, I think, is a risk that if people suddenly realize that there is risk in ETFs, rather like the banks suddenly realized there's risk in mortgage securitizations in 2008, if people begin to realize this, then you could have waves of selling, you could have stocks which are knocked, irrespective of their wonderful fundamentals. And that, I think, is a huge new dimension in the whole of equity investment with which we are not really familiar.
No, exactly. And you talk about in the article that this cycle could really be ending. You said the current cycle has been of declining interest rates since 1981, generating a valuation boom that has driven bond yields to all-time lows and equities to all-time highs. This cycle is unlikely to survive the current trend of rising consumer prices because of the unprecedented accumulation of private sector debt. So can you expand on how these rising consumer prices will not allow this bubble to continue?
Yes, certainly. The point about rising consumer prices is that the only way in which the central bank knows to control inflation, price inflation that is to raise interest rates. The problem is they've got very little room to raise interest rates because of the overhang of private sector debt. I calculate that if in America the Fed rose interest rates to somewhere between 2.5% and 2.75%, I'm talking about the Fed funds rate, then it is quite likely they would trigger, if you like, a debt-driven collapse. And this is the problem. And every credit cycle that we see, interest rates are raised to try and control inflation, price inflation, and they're raised to the point where you end up with a credit crisis. Those peaks in interest rates have been getting lower and lower and lower. And this is why I calculate now with the current level of debt that a rise in interest rates at the Fed funds level to around about 2.5% to possibly 2.75% should be enough to trigger the next credit crisis. So the Fed has got very little room for maneuver. And it's fascinating to see so many commentators talking about long-run prospects for interest rates. They think, well, interest rates could rise to maybe 1.5% sort of thing over the next 10 years. I mean, there was some sort of extraordinary prediction about interest rates to do with the Trump administration's budget forecasts. I'm sorry, but we don't get stuck with such low interest rates for long periods of time. Sooner or later, prices start rising, then you get the credit crisis. It happens every time. This is why it's so important, I think, for people to understand that it's not a business cycle, it's a credit cycle. And it's a credit cycle which is engineered by the central banks, and they have no control over it.
So you were talking about the Fed. Now, if this bubble is going to pop at sometime soon, in your belief, then why do you think the Fed continues to raise interest rates? And we just heard Wednesday that it seems like they're going to raise interest rates again in June.
Well, so far they've raised them to less than 1%. And I guess that by the end of this year, it could well be over 1%. If you look at the rate, the rates of inflation, they are picking up, and they have to raise interest rates. Also, they've got a rod. They've got a rod which is for their own backs over the unemployment situation. The level of unemployment in the States, I think, is very hard to quantify, because you've got a lot of people who would want to work, who can't get jobs. You've got a lot of people in low-paid jobs because they can't get jobs, sort of for the skills for which they have been trained. So you've got an economy which actually is not really at full employment, but the statistics says it's at full employment. And that is actually what the Fed's got to go with. So you've got full employment on the one hand, with unemployment below 5%, which was the target. You've got price inflation edging up over 2% now by various measures. And so the Fed has to raise interest rates. Their problem is that the statistics coming through seem to have contrary indications. Some statistics say things are sort of all right. Others say, oh, my goodness me, it looks like there's a bit of a collapse in, I don't know, inventories this week or something else next week. And you've got the retail sector in real trouble. And, lots of companies look like they're heading towards Chapter 11, Chapter 12. And so you've got all these cross currents. And if you're sitting in the Fed trying to sort of plan things, it's actually very difficult to get a handle on where the economy actually is and where it is actually going. So you can see that they're very reticent. They want to raise interest rates because they've got an inflation problem, and they've got full employment on official statistics. But from there, where do you go? Do you raise interest rates? Do you collapse the economy? Do you risk doing that? They're very sensitive to the fact that there is this debt trap. The private sector has got too much debt. If they raise interest rates too much, too quickly, then they're likely to topple the whole thing over. They know that in the Fed. And I think that outside the Fed, I don't know, I can't see anyone else actually quantifying what level the interest rates will go to before we have a crisis. My calculation, as I said before, is 2.5 to 2.75%.
Now, this isn't just a problem in the U.S., right? It's a problem around the entire world. We just saw Moody downgrade China's debt rating from AA3 to AA3 to A1, and Moody says the downgrade was because they see lower potential economic growth than the government's policy targets, and also Moody is concerned about the trend towards higher leverage. China's total debt is nearly about 260% of GDP. So isn't this over this problem of too much debt and over leveraging a global issue, not just in the United States?
It is a global issue, but I don't think you look to China for the problem. You need to look to Europe for the problem. Europe is in a huge, huge mess. At the moment, we've got the very, very sad case of Greece, yet again going for its fourth bailout, trying to agree terms, which basically means that the government survived, but the people get screwed. You've got Italy coming up in the lift quite rapidly. It won't be very long before we've got people like Portugal and Spain and all the rest of it. Europe is really where the big mess is. Now, the reason that I'm less worried about China than I am about Europe is partly the European story. But when I look at China, China is a controlled economy. It is effectively run by, if you like, a mercantilist junta. The President Xi and the Communist Party there basically run the economy in the way they see fit. It is a command economy. Everybody obeys it. They know that the long-term interest of the people is that they get it right. That is what worries them. It's not democracy, and it's a very, very different situation from the one which we're familiar with in the West. People keep on saying that there's the potential for a banking crisis. I say no. And the reason I say no is because the Chinese government owns the banks. There are some banks which are outside the ownership. I think that what would happen in a crisis is that the Chinese government would let those go to the war. What China is actually doing at the moment is something which isn't captured in the S&P numbers, and that is that China is trying to reduce, if you like, the bubbles, the debt-driven bubbles in the private sector. And the principal ones at the moment has been the punting in commodities in the wealth management products sector. Wealth management products basically regard them, if you like, as investment trusts, mutual funds of one sort or another. And basically what the wealth management products have been doing is they've been front-running the government's purchases of commodities. And obviously the government doesn't like that. The government doesn't want that. It would rather have, if you like, a free run at its commodities. So that has been the shakeout that we have seen recently. And of course it has also affected particularly silver, which has really been crucified. There's an extra element to it, because the rumor is that Noble, the commodity traders based in Hong Kong, have been liquidating their silver positions because it's about the only thing that they can liquidate from a relatively illiquid portfolio of base metals. So that is the basis of the shakeout. But this is deliberate. This is something that the Chinese government is doing because they want to control the whole situation. What interests me is that there's been a certain amount of blowback on this ratings situation, where people have decided that it's bad for the currency. The problem that they have is that there is a continuing trade surplus, if you like, in yuan, and that basically means that you got buyers of the yuan the whole time, because you have this trade surplus. So I don't really see the problem there. What I do see is I see a problem in Europe, and that is actually where we ought to look, and particularly look at those target 2 balances. And these are the imbalances that reflect capital flight out of the weaker nations into the stronger nations. So you've got Italy, Spain, and all those weaker countries. The people within the banking system have been withdrawing their funds from the banks in those countries and moving them into the banks, principally of Germany, Luxembourg, the Netherlands, and also Finland. So to my mind, that is where the next crisis is. And I have to say that I think that the Brexit situation, which the negotiations will basically commence shortly after the general election in this country, in Britain. And I think at that stage we'll begin to see that actually the situation for the EU is not that good.
All right. Well, Alasdair MacLeod, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, you can find me online at goldmoney.com. And if you click on the wealth section, then all my research is under there. And I write a weekly insight column, and also I write a weekly market report. And the insight column comes out on Thursdays, which is the day of this recording, and the market report on the Fridays. And of course, I would say this, I think, is recommended reading.
All right. Once again, Alasdair, thank you so much for your time today.
That's my pleasure, Elijah.